case study of CGA, just for understanding. So you are a qualified CGA, so you think, and are the financial director of a company, FIR Limited. FIR is a multinational company. Reporting currency is US dollar. So here, different types of information is within one line. So role of you, who are you, or who are I, who I am, who are you, who I am, where I am working, and how I will report everything. The currency reported is US dollar, working in the multinational company as a finance director, as a qualified professional. Here, FIR is a clothing retailer for 10 years. So that multinational company also a retailer company, clothing. Here age is 10 years. The companies, that means that chain market is within the world. So the company's year end 31st December, and you are the finalizing the year end account. So here the accounting year January to December, and you are, in our country, as per the law, as per the tax law, banks, financial institute, and their financial year is January to December. Other than banks, financial institute, all financial year is July to June, because of similar to financial year and our for tax purpose. So is our country's year, but that company is January to December. You have recently been advised to the warehouse manager, in your warehouse manager, of significant level of slow moving stock. That means your stock is day by day is increasing. Movement of stock is slow. Say you, say warehouse manager or a store manager. The stock in question is now more than 9 months old and would normally have been written down some months previously. So 9 month old stock you are keeping in your storehouse. The shareholder are trying to sell the company. So the shareholder or owners want to sell that company. And the CEO, he is the majority shareholder, has told you that it is not necessary to write down the stock in the year-end account. So, saying that do not write the stock in the account, but if you say that is a sell, if you see the sell, then your accounts will be huge profitable account, because CEO wants to sell the company. You are sure that the CEO wants to financial statement to carry an inflated stock valuation because he has found a prospective buyer. Because CEO is get a buyer and want to sell the company and asked you to inflated your stock valuation. The CEO has indicated you to that if the proposed deal is successful, all employees will keep their job and will be receive a pay increases. So CEO also give the information to the pass the information that if that those respective or prospective buyer, then all employee will give the person, because no terminated will be there and salary will be increased. This is the theme. And now pointed what is given to do the case study. Key fundamental principle is here. We will see it 109 page. And consideration, possible course of action, board of directors considering the company's capital investment action. Also another board of directors, they considering the capital investment in 3 stages: investment XYZ, and expansion by the organic growth by the acquisition. We know the organic growth in our side. The statement of financial position of 2 companies as the December 20 financial reporting of FIR. etc. in a difference exhibit 7 is here, and requirement also marks and requirement is given here. So if you put the executive summary, so all summary taken in the executive summary after doing the all math answer and few key point we'll put to the executive summary. So here executive summary, if we do, we'll get 20 marks. And you have been asked and advised to the board in the form of brief report which investment should be undertaken. So investment is three: investment X, Y, Z. So which investment should be undertaken in your report? You to make use the NPV method, as the members of the board believe that it is the best to use, have asked to use it. So after you will calculate these three investment proposal through the net present value, and you will report to your board briefly. And C, minority of board of members, because board of members is here also minority board of interest existing. That minority board of directors, they ask that internal rate of return IRR should also be used in either the alternative of a complementary method of investment appraisal. Need the calculation IRR investment X, Y. You may see 25% as the upper limit if you wish. Okay, and the comment accordingly. So also minority interest holder who have within the organization, they asked they prefer internal rate of return, but majority prefer net present value. So we have to calculate also IRR marks 20. So also evaluate the favorable of this taken over of MMS Limited and comment your computation 20 parts, and prepare a consolidated statement of financial position of that group, acquired group, 20 marks, total 100 marks. And now if we question, so fundamental principle is the logical principle is integrity, objectivity, professional competence and due care as an accountant, and professional behavior we have to do it. So this is the fundamental key principle. Why is come here? That's why CEO asked you inflated the inventory and make the financial statement as very lucratively, and if you do it, then your job will be kept and your salary will be increased, as well as all employee will take there, because CEO wants to sell the company to another customer. So being a professional, you cannot do it. So you have the integrity. So integrity, what is integrity? Integrity is the light of the information you have. You must ensure that you act honestly and that you are open and straightforward towards those with whom you come into contact. And objectivity, you cannot that means can you act without bias despite the significant threat in the form of self-intervention and limitation. And professional due care also, you must act as a professional, and professional behavior require the accountant here a stop of accounting with relevant accounting standards. We know accounting standard we are using for the inventories accounting international accounting standard 2. So would any action be considered discredit the profession in the opinion of the information third party? So exhibit 2 says that consideration. So here identify relevant fact. You are receiving conflicting information from the warehouse manager and the CEO. The CEO is putting you under the pressure to account for a stock at a higher value that which feel comfortable. CEO comfortable, but you're uncomfortable. He proposed misappropriating information about the company in the financial statement, which would be contrary to the fundamental principle of the integrity. So, fundamental principle of integrity, we cannot do it. As a self-interest threat of your objectivity arise from the financial benefit that you are likely to receive if the company is sold under the proposed deed, you are also feeling intimidated by the CEO. He appeared to suggested that the future employment of other employees depend upon the proposed deal being successful and therefore upon the result shown by the financial statement. So it's the threat. Identifying affected parties. Key affected parties are CEO and the other shareholder and the potential purchaser of the company, because CEO will make benefit after selling the company, and who purchase the company, they will be lose. So other employees of the company may also be affected, as it has been implied that their job is in risk in the proposed deal is unsuccessful. So who should be involved in the resolution? You should involve your warehouse manager, your CEO. If necessary, you will flow the board. Now, Exhibit 3, possible course of action. You cannot simply do that what your CEO asks. So that type of theoretical decision is here. So, but you have to read it, because look here saying that decision with the CEO may be made easier by reference to the company's own code of ethics. It is as one. If it is does not, if companies do not code of ethics, then you can see your CEO award the ethical requirement of your professional body as a CA, CMA, or IFAC professional issue. You can see sit with your CEO. So you could suggest the company engage the independent expert to value the stock also. It can be your suggestion. So this is the one. And board of FIR consider the company's capital investment option. Now is your work also. In another situation, FIR considered the company's capital investment. That was another situation. This is another situation. And board of director once give a few options to also evaluate the following potential investment. So investment, three investment is here. Investment X. So here saying that in investment X, the investment of similar of this current investment and required the investment 60,000. Now 40,000 for new capital equipment and 20,000 for increase in the working capital. So requirement is $60,000. This will be financed from the shareholder fund. That means equity financing. Expecting the sale of next year 10,000 units of that investment, and variable cost would be $6 and the product would be sold $10. So here your margin is $4 is your margin. So, but due to the entry of the new competitor and technological improvement, the sale price would decline 20%. So, what is 20%? $10 of 20% per annum thereafter, full years. Sale volume would fall 10% and variable cost would fall 20% per annum. Overhead attributed to the project would be 15,000 per annum. In the year 3, the project would round up. So 3 years project, working capital investment would be recovered and capital equipment sold 25% of this purchase cost. So after 3 years, that $20,000 working capital, that working capital released from the fund, from the project, and 20% of the purchase cost follow year. That means that machine would be sold 25%. Fixed cost incurred annual charge 4,000 for depreciation. So this situation is investment X, and if we go for the we will go over to the solution. Before going solution, just we will put the whole question is here. So this way, when you read it, just mark it key point for understanding and for solution to solve the problem. And if you see the investment A, why? This is the long-term project, is very new era. So is the long-term project. Involve immediate outlay $90,000. Who is the intended to borrow from the lenders? This is the lenders. That means it's a debt financing at the rate of 6%. But previous one is the equity financing. The expected net profit 12,000 next year, raising thereafter 3% per annum perpetually. So it perpetually, that means year after year 3% will be increase the profit. Long term project profit is 12,000 per year expected profit. And investment Z, this is another long term investment, is very new era, also is a long term investment. Involve the immediate outlay only $25,000. Who is the intended financing? Retained profit. That means no cost is here. That means retained profit within the organization. The expected annual net cash profit first year to fourth year 3,000, and fifth year to seventh year 5,000, 8 years onward forever 7,000. The company discount all project for 10 years duration, less the cost of capital 10%, and the other project 13%. All project income tax free. This is the three situation we will solve later on. And then expansion by the organic growth by the acquisition. So here a company is going to acquisition, need to discuss two strategic issue. Okay, so FIR has the current price 2.2 per share and price and a ratio 15. At present it has 10 million $1 ordinary share. If we are considering the taken over MMEs Limited, the current price of MMEs is 4 million, issued share 3.3 per share. MMEs price earning ratio is 10. If we are expected to avail to purchase the share at their current price and will pay from with the issue own share value of their current price. So we'll adjust current price share. If I wish to know how many share of offer to MMA's share, that means exchange ratio shall be calculated. How much share should be issued? Exhibit 6 said that finally purchase 4,50,000 ordinary share MKIN Limited, another company, and purchased in 2016. General reserve of MK stood $4 lakh and there were no retained earnings. The statement of financial position of two companies here, one is FIR, who are going for purchasing. MKIN, now it is the one subsidiary company. So its financial position, that means balance sheet, asset, liability, everything is here. So at this end of the reporting period, the MKIN Limited was agreed 23,000 owned by MKIN current account, that is within both company. This account is including the apportionate receivable and trade payable balance show above. There has been a goodwill since the acquisition. Now is the final one. So here it is the group policy to value the non-controlling interest as the proportionate share and fair value of the subsidiary's net asset. So this is the acquisition, and it's the consolidation, all the balance sheet. And now final one, financial reporting refers the standard practice to give a stakeholder. So is the saying that we need to revenue, expense, profit, capital, cost, etc. in depth with the financial information. And the objective of financial reporting FIR this company to analyze, report business income. The purpose of this report is to examine resource users, cash flow, business performance, and the financial health of the business FIR. This helps FIR, the investors, make informed decision about how to manage the business. So this is the total our case study here, model case study, and now we are going for the solution. After solution, and that would be easier, no problem. So here go for solution. First executive summary, we'll read it, and after completing other thing, advice to the board is the requirement B. So 3 investment. So here we have to calculate 3 investment X, because most of the board of directors want to know the NPV situation of 3 investment. So first, investment X, you calculate these NPV. So here, as per question, sale and variable cost, then we minus the overhead, and then we'll get net cash flow. Here cash flow is 29,000, 70,000 in the years 2, second year. Our cash flow would be, we have to calculate the cash flow, because as per the question pattern, the 17,800 is a cash inflow, and in the year 3, 29,730, and 4 here capital investment over 10,000 is count of the 25%. So here capital investment 40,000 X, and then 10% our discount factor. If we put the discount factor, we get present value. Present value of year 1, 26,361, 2, 3, 4, all calculating, we get the net present value 10,226 dollars. So here investment X complete. Now here calculate of this X sell unit, how they calculate it, and selling price per unit, that means low the selling price here, and variable cost also low. So total sale value calculating here, variable cost calculate this from this variable cost. This figure, look here, in the year 3, 31,104, discount from here 31,104. Same way investment Y. So here 13% growth is 3%, cost 90,000, cash flow 12,000 per annum. So net present value benefit minus present value of cost. So present value benefit comes 1,20,000. Calculation is here. You go later on, and NPV here comes net present value only 30,000. Joe is the perpetual side, the long-term investment. So this we can calculate net present value 30,000. And same way we will calculate PV benefit and minus. So present value of 7,000 per annum and perpetuity, we get this way 50. And here if we less the present value 7,000 1 to 7 year, multiplies discount factor. If we less from this figure, then we'll get here that figure. Thus PV of 7 years for the 8-year perpetuity comes this way. So also discount factor 1 to 7 years is that for 30%. If we go for the table, discounting factor table, then the discount factor 1 to 4 years there. If we minus from that, then we will get the discount factor from the 5 to 7 years 1.46. So from this discount factor, we calculate here from is it 0 year opening year. So here 1 to 4 year 3,000, 5 to 7 year 5,000, 8 plus 7,000. So here discount factor we get this way. This one, look here, 5 to 7 we get 1.448 here, and this one to this one 2.974 is here. So multiply that, we are getting this total 22,888, net present value 14,050. So what would be your suggestion to the board of directors? As all projects have positive NPV, all be undertaken. On the basis of the NPV criteria, project A has the greatest positive NPV, following the XYZ. So this way you can calculate approach to your board of director. This one. Now, separate situation, that same figure, your minority board of director asked you to calculate the internal rate of return. So here you have to calculate the internal rate of return of investment X. So here is come here we first we know the if we want to calculate the internal rate of return, then we have to find out two NPV. One is positive, one is negative. Then after taking the all data, then we will find out the internal rate of return. So here as we calculated 10% previous one, that was just here, look here. So you can refer this one. So here investment of AX, NPV 10,200 positive. So here just 10% discounting factor we taken. Now if we take the big one, then we will get the negative NPV. So here directly here taking the 25%. So here negative NPV that 6,083. So putting that data in here, we get the approximately IRR is 19.4%. So this one. So why same way here NPV and taking a percent. So net present value is that 30,000, and also here -1 calculating. So this same way taking the 18.50 approximately here IRR here. So this is this for the this one Y. And another thing here, if we see here, they ask you for XYZ investment. So Z investment is here, but IRR we can calculate for the Z investment because all investment is from the companies retained earnings. So this is the scenario. So this scenario for the minority shareholders. Now, expansion by organic growth or acquisition. So here for taking the advantages organic, here we have to take the time, merge of acquisition, when we can merge it, and we have to calculate and understand the cost and regulation we have to follow, assimilation and strategy we have to take, organic growth. And that is organic means that inner the organization, organic. So here they involve the firms expanding its customer or products base using their own internal resource. Alternatively, this can be achieved through acquisition or merge. Here saying that alternative, this can be achieved through acquisition or merge to another company. So here a company pushing the policy organic growth, the policy is optimizing a scale of production, human resource should be accurate, and a capital resource allocate or use in the properly, cost would be minimized and risk free, etc. So this one. So number of share MMS when we go for the taken over, and that was 40 lakhs or 4 million, you can say. Price of share MMS at this moment 3.30. So value of the MMS is here we can say is 40 lakh multiplied by $3.3. So here comes 132 lakhs. Number of share of offer. How many share have to offer for buying that MMS by the FIR? So here total value divided by share value of that. So here 6 lakh shares should be issued. So here limit share offer would be 1.5 show. 1.5 or MMH share offer of FIL Limited. That is 3 share of issue 2 share MMH Limited. Effect of the taken over. Effect would be P15. So EPS of FIR before taken over EPS was 14.67, but after it would be what would be which one that earning FIR before taking eto earning MI Limited total earning combined earnings should be that one. After taken over combined earning 27 lakh 87,000 earnings should be increased, and both earnings is here, earnings of FIR and earnings of MMS that company is going for taken over. So after taking over, total earnings will be 27 lakh 87,000. So share of FIR before taken over 10 lakh, share issue MMS taken over for 6 lakh. This 6 lakh share should be this 6 lakh share should be issued for taken over MMS company by the FIL Limited. So share would be increased 60 lakh share increase. Okay, so total share now after taken over 160 lakh. Yes, look here, total is total earnings now 27 lakh $87,000, and number of share after acquisition or taken over here 160 lakh. Per share now value is 0.174 because number of share increase. Share price FR after taken over would be price earning ratio of 15 as per the question, and price 15 minus this price, look here 0.174. If we multiply the price earning ratio 15, then we will get 2.61 per share value. Going for taking over issue. So here you have to take some comments. The taken over has been considered favorable of FIR because it has the improved EPS as well as enhanced the share price 2.3. So this way, now the suppose of the shareholder of 1000 share limited. So if MOA has 1000 share, look here, the previously 1000 share value is 3300. Value of after taken is come here. So increase value is for 10,000 share 651. The shareholder will gain is also within the question. If 1000 share hold anyone, so how much gain they taken over? So here gain 615. So the shareholder FIR would suffer a dilution control as a result of the taken over. They would be considering 37.5% of their control to the shareholder invest. So this is the suggestion for the company is the after taken over. Now final one is the consolidation as per the figure. So we have to consolidate the statement of financial position also, not only the financial position. 20 marks. So all workings is here. So here taking the group structure is taking FIR and MTIN Limited. So here taking the controlling is 72.5%. Goodwill calculation here, and non-controlling interest calculation here, return earnings calculating here, general reserve calculating here. All calculating after all calculation, all figure putting in this financial statement, asset here current property, goodwill calculation working from working one, then total asset come here, and current asset also come here, inventories, and receivable to receivable minus 23, so come here. So total asset is 17,285, and here we are taking 3 zeros here. And same way equity and liability, so equity taking here, and liability same way, trade payable, this adjustment is here, all is here. So it's all for today, and hopefully, and it is our last class of this study, and don't afraid, and just start for exam, no problem. Just if you start, then all will be happen. Part, and that's just explain that one, the executive summary, the principle of integrity, because within this problem, a CEO asks to finance director you to do misleading things and misleading or false thing for inventory purpose, so you cannot do it. So it is the part of executive summary. And also you calculate the three investment XYZ for the major shareholder, the criteria of NVP. So you just put that one. So you calculate IRR as per the suggestion of the minority stockholder of that company. So you just put that on this. And organic, what do you mean by organic things? And the taken over issue, positive thing, and that consolidation issue, just putting the figure only here. And finally financial reporting. So this way you can finish your executive summary. If someone see the executive summary, they will get the look the overall picture of that total solution. So this is the executive summary. So it's management or board can take some decision after seeing that executive summary.